Happy Friday, friends. It's Shayan with Integrity Home Mortgage, back with your weekly rates rundown for Halloween, October 31st, 2025. I was going to do some clever, spooky Halloween themed commentary today, but I just can't bring myself to do it because right now I'm feeling shut down and fed up. Why? Well, because a month ago, when this whole debacle began, I assured you that government shutdowns tend to be short lived and they tend not to have lasting impacts on the economy. But 31 days, we're now approaching the point where I'm not so sure that we can bank on that statement being true. This is the second longest government shutdown on record, and it'll become the longest if it continues into early next week, which looks like a virtual certainty right now. 670,000 federal workers have been furloughed so far, 730,000 are working without pay. The Congressional Budget Office estimates that the resulting consumer spending curtailments lead to about a 1% drop in GDP for every 4 weeks the shutdown lingers. Now, many will want to point out that a lot of that will be reversed when the government eventually reopens, but try telling that to the businesses that don't make it to the other side. Not all of this will be reversed. I'm not necessarily sounding the alarm bell quite yet, but I am pointing out that we are nearing unprecedented territory. And at a time when the economy is showing some early signs of weakening, risks of lasting impacts are mounting. Speaking of lasting impacts, the Fed met this week, and as expected, they lowered their benchmark rate by 25 basis points. Also, as expected, they announced an end to their balance sheet reduction efforts, often referred to as quantitative tightening or QT. This won't have a huge impact on interest rate markets in general, but it should be incrementally supportive for mortgages once we get through this initial period of volatility. The real headline came after the rate announcement during Chair Powell's press conference, where he came off as much more hawkish than he has in recent comments when he said a further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. He went on to clarify that the next meeting is 6 weeks out, and we don't know what we'll get in terms of new data or if we'll get anything new at all by then, and that uncertainty could be a reason to be cautious about making additional cuts. It's on its surface a reasonable argument, right? If we don't have any way to measure impact, then we can't know whether additional actions are appropriate. That being said, he's saying this to a market that was looking at a December cut as a foregone conclusion. Now, maybe he's just saying what needs to be said, and markets aren't quite ready to hear it yet, but we also must acknowledge that being cautious does not necessarily mean stop. After all, if the economy is continuing to weaken, then not cutting is what could be the most detrimental thing, right? Not doing or doing nothing is still doing something, and you could be introducing new risks. So futures markets went from pricing a near 100% chance of a cut in December down to a 60% chance now. Uh, and as a result, mortgage prices have basically given up all their gains over the past 2 weeks, and that's the bad news. But the good news is that we're still right in the middle of the improved range that we've been enjoying since the September jobs report, so not all is lost. Next week would normally have been jobs week. Seems pretty unlikely we'll get official numbers for payroll and unemployment rate. But we will get some private sector data, and markets are sure to react to any surprises. Given that last week's inflation data came in slightly lower than expected, jobs continue to be the market's focus. Weaker numbers, right? If we get weaker numbers next week, meaning higher job cuts, lower hiring rates, that should allow mortgages to pare back some of this week's losses. But if it looks like there's an indication that labor markets are stabilizing, I'd look for 10-year Treasury yields and mortgage rates to back up another 8 to 10 basis points from here, which is about 8 to 10 basis points worse than they were before the Fed meeting. That's it for this week. Happy Halloween. Have a safe and happy Halloween, and we'll see you next week.